afternoon, everyone. We are now just getting the last few people seem to be filing in, so I think I'll start. My name's Elliot Rowe, and I'm here today to talk to you about the UK property market and what's going on, and with our very aptly named title, to buy or not to buy. So as I mentioned, I'm Elliot, based here in the Dubai office for the RPA group. So today, the main sort of points we're going to go and cover and sort of really look at, sort of drill down into actually what's happening in the market as it stands today. So, you know, what's happened to house prices, how have they performed in the UK over the last sort of recent months. We're going to have a bit of a specific look into London and see what's happening there. Also, just see what we think about the next 5 years and how we see the market moving forward as well. I've got a few examples of some opportunities that we feel are really quite fantastic that are based in the UK at the moment. And I'll sort of discuss through the numbers there and what we feel, sort of figures you should be looking and sort of returns you should be looking to expect to receive. Okay, so just a sort of an overview of the market at the moment and sort of where we've come from, really. Obviously, we had the sort of the pandemic, 2020, and what then sort of that created in terms of the sort of stimulants to that market and sort of the activity that we saw. With a stamp duty holiday, we saw a lot of people from sort of the relic of the pandemic wanting more space, that race to space. We had low interest rates, so this created a really strong market. But if you're looking back over history, you know, that's not a typical market in the UK, but we saw incredible sort of house price increases during that period. And so that's sort of an element of that sort of made a sort of a market that maybe wasn't what we would expect, generally speaking. Now we're moving into, again, sort of in inverted commas, more of a normal market. And what we're seeing is people have sort of moved into sort of particular areas of the UK looking for particular yields, like the north of England, for instance, with the house prices being so high and the rents not sort of catching up. We saw the higher yielding properties certainly in the north rather than in the south. And that sort of led us into where we are today, which is, you know, we have got inflationary concerns, and then we've sort of got rents now going sort of the other way, house prices maybe stabilizing and sort of rents increasing, which is creating a lot of opportunity throughout the country when we're looking at things from a residential sort of investment perspective. So the sort of the latest house price data, and I sort of actually split this sort of chart, this graph page even into two parts. On the left hand side is actually historic, and I'll come on to that in a second. But on the right hand side, these are figures that have literally come out over the last couple of days. And what this is showing us is that over the last 6 months of 2023, we've actually seen house price growth. Last month was the first month to drop in terms of house prices. So technically, house prices have dropped, but what we're talking about really quite insignificant sort of numbers. The house price drop was by £82. So the current average house price throughout the UK is £372,000. What we're also seeing is that the buyer demand has not slipped away, and that's something I'll come and discuss it in much more detail shortly. But the buyer demand hasn't, despite the high mortgage rates and the volatility in that mortgage market. So the demand is very much still there. As I sort of mentioned earlier, the north of England had seen this sort of the highest house price growth up to sort of, you know, last month. And as I say, my top comment is on a national perspective. And when we look into specifics within the regions, we'll see some areas have gone up, some areas have gone down, and on average. So when we're looking at sort of on a year on year, the northeast saw the highest growth of 5.5%, and London recorded the lowest at 2.4%. That's on the house prices, and then what that's actually then done to the rental market is we've now seen a one of the highest, if not the highest, sort of rental per calendar month on average of £1,213, which is one of the, as I say, one of the highest on average that the UK has ever seen. Now, sort of taking those all very modern day specifics and looking at that house data now, and looking at why, why that sort of reacts, the UK market reacts like this, and we look back over say a 50-year period, and actually it continues to perform. So what we're looking at here is in 43 out of the last 50 years, we've seen positive house price growth across the board, and an average of 5.5% per annum. Now, this is down to a few key factors, mainly the demand outstripping the supply. But over all this time, property has only been the worst asset class in 25 years, and 6 times in 50 years. So it just shows the robustness of this market, and that even in higher inflation times, in tricky economic times, we're still seeing positive results from the market. And as I say, on the right hand side, that really sort of explains it quite clearly. Looking at the and as I mentioned here, we're looking at sort of particular regions, and you'll see highs and lows in different areas. But I think what's quite important here is, let's look at what's happened since 2019. So since the pandemic, we've seen the jump, but on average over those 3 years, and what sort of results we've seen in terms of a 3-year growth. And as you can see, London hasn't necessarily performed that well. In fact, you'll only have seen in the last 7 years with London a 12% increase, but that also then gives opportunities to investors into the residential market when you're looking at buy-to-let, obviously. We have seen in areas like the Midlands, where you've seen sort of significant growth within those urban areas. So you're looking at sort of 13.3% over a 3-year period, which is really quite impressive. And also, and you'll note on the graph on the right, coastal areas. Again, this is that race to space that we talked about, and people from the pandemic and looking to live, not having to go into work, or working from home a lot more, or going to the office once every 2 weeks, or whatever that might be. So coastal areas have seen significant rises of up to 22%. So basically, what I'm saying here is, we can look at the averages and we can look at everything that happens across the UK, but when we look at it into specific areas, we can see opportunities and that can really sort of help make the sort of the right decision when you're looking to invest in a sort of a buy-to-let property in the UK. Again, this is just going back and reinforcing the comment I made earlier, but I think it's always useful to remember, looking back at house prices since the sort of late 60s in this instance, but records sort of go back even further than that, we're seeing a steady upward trajectory on house prices. And what that means is that we've got historical evidence to give us that support on where house prices are going to go. And ultimately, and whenever you're looking at any of these investments, we should be considering it for a minimum of 5 years. Minimum of 5 years, and on average, every 10 to 15 years, house prices double. You're going to be buying a secure asset that is going to give you significant benefits when you're looking to rent it out, and then ultimately when you're looking to exit. It's certainly, we have that security, and we have the faith in what the market has previously done, no matter how turbulent sort of current markets might be in every other sort of sector. So again, looking at specific, I mentioned the Northeast earlier. Now, and we just sort of looked at London as well from a perspective of house price growth has been probably one of the weakest in sort of the country in terms of in sort of the 3 years and since sort of 2019. But what we've actually started to see is a recovery in London, but equally that brings opportunity as well. So we're starting to, house prices are starting to sort of tick up in London. We are seeing sort of activity levels picking up. Prices seem to have found the right level, as we're finding that sellers are, on average, achieving 97.5% of their asking price. So this is all starting to move in the right direction. Now, from an investment perspective, and I think one of the most important things to note here, and where the opportunity lies, is typically in London, you won't necessarily, compared to other areas of the UK, the yield is often significantly lower than you would find in other areas. But when you see the fact that the rest of the UK has grown, say, in the last 7 years at 32%, and London has only grown at 12%, then we start to see where there is an opportunity to see the next wave within London itself, and that next growth. And what that also means is, when we're seeing rents increasing as dramatically as they are, that your yields are really starting to look really quite attractive, and even more attractive than you're going to find in other areas of the country. And so when we just talked about London, we talked about the North, and now just looking at the buy-to-let market in particular, and where those opportunities arise. As I mentioned about the house price rise in London has been less than many other areas of the UK over the last 3 to 7 years, but actually now we're seeing rents on average are recorded last month was recorded at the highest ever at over £2,000 a calendar month. So our property values have sort of flatlined, stagnated, if you like, but our rental values have gone extremely high. So now we're starting to see really quite attractive yields, and landlords, and in particular landlords that probably own sort of a portfolio of sort of minimum of 5 project properties and that sort of thing. So very experienced within the market itself, and now actually seeing that opportunity. So when we're looking at, there was a land-based landlord survey recently released, and 41% of landlords are looking to buy more property in the next 12 months. Now, if you're sometimes reading the papers or the headlines and that sort of things, and people are talking about a market that is difficult, that there is interest rates are killing the buy-to-let market, that there isn't, that landlords are all flooding and leaving. I think the reality is actually slightly different because of the opportunity that's become available. What has also happened here is that we don't have, again, this is going back to sort of what I was mentioning earlier, but the levels of home that are available. So again, the supply and demand is 20 to 40% below the pandemic levels. So that's why we're seeing rents rise so much, because there just isn't the property available to rent. Again, another really good opportunity there for landlords to get really quite significant rents. You're looking within London itself for this summer, they're expecting a 40% increase in tenant demand within the city. And we've already just received the highest calendar month of over £2,000 on average for a rental property. So for the savvy and the sort of educated investor landlord is now realizing now is the time to buy. Prices have plateaued, if not dropped a little bit. Rents have gone incredibly high, and there is a shortage of property available. And this is why we're seeing, from our perspective, sort of a really positive and fantastic opportunity. Now, if you then take some of your larger institutions as well, the buy-to-rent sector in the UK, build-to-rent sector in the UK, where institutions purchase large blocks of apartments of 100, 200, 300 apartments at any one time, maybe dotted within a particular project or in a particular city, they are all investing within this, which is one of the highest sectors to grow in the last 6 to 8 months, because they are seeing an opportunity to buy property at a good level, and that rents are ever increasing because of the lack of supply. And so therefore, from an income play, it works perfectly. Even when we start looking at high inflation and high interest rates, rents are going up, which does counter a lot of that negativity when we're looking at those interest rates. So when you actually drill into these figures, and we're actually looking at what is happening with the rent, what is happening with the opportunities, right? Sorry, I was just checking, and I noticed that I've got some Q&As coming in, so I will get back to those and remember to answer them. But this is where the opportunities are lying, and as you can see, the figures, these are the most recent figures. They've literally been coming out over the last couple of days, and I've used these to put this presentation together. So, talking of particular areas, and I'm just going to use two particular regions. I'm going to look at London and Birmingham as a particular project. Two particular projects that we have to offer, but basically this is what we feel as a business, and as we're advising our clients to find these hotspots of a strong amount of strong rental demand, so we're achieving these good yields, but also why we think these particular areas can see growth where others aren't. And so the first one I'm going to discuss is Hendon Waterside, which is in northwest London, in Hendon, and the block we're going to look at here is called Goldfinch Apartments. So this is a new launch of ours, 63 units across 1, 2, and 3 bedrooms. Prices starting from 392,000. And this is the interesting bit. This is the bit that really got my attention when we started looking, doing our DD on the project and seeing if we wanted to take it on. We're looking at sort of yields up to 6%, and in some instances, some of the apartments are actually achieving more than 6%, which, when we're looking at a project in Zone 3 in London, is incredibly rare. I started working in London back in 2007. Throughout my career till 2018, that if I saw a project or a property that I felt that had a sort of, that I was going to see an opportunity from a capital of growth as well, but to get a yield of anything north of even 3%, I deemed as a very good investment. So when we're looking at things at 6%, it's just a different way of looking at these projects, and understanding that London, there is actually as much opportunity, and if you want a yield as well, it really is a fantastic opportunity. There really is a lot there, a lot to be said for getting into a market where you're going to be able to achieve those sort of results in an area where we see a lot of growth. From a payment plan perspective, you're looking at a 10% down now, and then 90 in, and then 90% in Q2, so sort of June next year is the expected completion date. 999 year lease, and sort of finally, but certainly not by or at all least, is the fact that we're working here with one of the UK's largest developers. So we're working with Barratt Homes, large PLC, who have really produced a fantastic scheme. The scheme is sort of halfway through its project. You can see down here in the bottom right hand picture, it runs alongside Welsh Harp Reservoir, and it covers about I believe 17 acres, and then it's going to be about 2,000 homes. And there's about 1,000 homes that people already live in. Has fantastic accessibility into central London with the Northern Line and Thameslink. I'll come on to a second, but as you can see here, it's a complete new build, and in an area where you historically had been sort of cheaper, low-cost housing, and then basically back in 2012, Barratt purchased the whole site, demolished, and then started to rebuild and build a new community. But it's on the side of a reservoir, green open spaces around, and is unique to central London when you consider you can be in Bank in sort of 20 minutes on the train. So each apartment comes with a balcony, and there are open spaces throughout. This is the sort of interesting connectivity element to the project. You know, you're 8 minutes from West Hampstead, again, one of the most sort of affluent areas of London. You know, you see with the next stage up, you've got Brent Cross Shopping Centre, which is literally just 1 foot 20-minute walk, 5 minutes to the train station, 16 minutes to the tube station, onto the Northern Line to connect you with the city. Fantastic accessibility into London, as I say, from the city perspective, especially for working in the East. Gives you a better idea of the project and the full scheme itself. You can see obviously the reservoir in the top left-hand corner. You can see Wembley across in the distance, and then you can see the scheme across here. If you can see my cursor, this is where our particular project is. So we have units that have views out across the reservoir. We have internal views into the courtyard as well. This particular block is available to us here at the RPA group, and really has some fantastic views. You have 4 large towers, and the rest are slightly lower, up to a maximum of about 10-12 floors, but with the 4 larger towers. And then you can see here all this parkland and open space, again, with the connectivity that I just mentioned into London, and to have this around it really is a very unique and sort of desirable place to live. You know, there was, as I say, there's a 2,000 units scheme, 1,000 units have already sold and are tenanted and have people living there, and so it's been really well received. So that is with regards to London, and an opportunity that we see here. So just to reiterate on this one, we have 1-bedroom apartments. Actually, I mentioned 390,000. Those are sold now, but we started so around 400,000. 10% required now, 90% required in a year's time. However, this is producing yields of north of 6%. So the rental values are really quite impressive. And these are, we know we're able to achieve these because people are already living there, people are already paying that. So if you're looking for an occupier opportunity where in a year's time we are expecting rates to be in a slightly different place, that 6% suddenly looks even more attractive because it's supplying you an income, buying a property at today's price, which is something that I think is it's certainly been considered by a lot of our clients, and already a number have been bought, and there's an opportunity there if you wish now. Okay, so the second project, different location. We're now moving up the M1 into Birmingham. So we're looking at Birmingham being the UK's second city, and this is a project we've had on for a little while. So for 3 or 4 months, has been very popular, but it's the third phase of a scheme that we've sold throughout. So first and second phases have been very successful. This is the third phase, which is off plan, completing in 2024, in Q4 2024. We have 1 beds from 220,000 and 2 beds from 295. This is again a smaller scheme, 53 units available in this block. And basically from the success we've had in the first 2 phases, that this has already been so well received and been a really positively taken by many clients already. Yields in this are up to 6%, quite interesting, or 6.1%, where with Barrett, with the London scheme, we're looking at sort of north of 6%, with some units we're up to just about 6% with regards to this project. Slightly different in terms of sort of location. This is much more of this is a city centre location, and is also in a conservation area in the Jewellery Quarter within Birmingham itself. So slightly different offering. Although this project looks like it may be maybe an existing conversion, it's actually a complete new build, apart from one small facade on the right hand side. But it basically, to keep in with planning within the local area, you need to ensure that it's everything that's been built within this particular area of the Jewellery Quarter in Birmingham is in keeping and is with its current surroundings. So why do we think Birmingham in particular, and why do we think this is an opportunity like we see with Hendon and particular areas in London? Well, actually, it's more rather than it being historical evidence and what we've seen happen with regards to Birmingham, it's actually what we're seeing moving forward with Birmingham and the opportunities that lie. So I think the best way to describe this is that Birmingham is seeing the most amount of international companies move to a city outside of London in the UK. So we have seen the likes of HSBC, PwC, KPMG, Barclays, Deutsche Bank all move from their sort of head office or back head office offices from London to Birmingham. Most recent, which was very incredibly obviously famous name in the financial world, is Goldman Sachs. This is really changing the sort of face of Birmingham. These businesses, these international corporations, saw an opportunity to improve their profits, to improve their performance by moving location, because of the availability of space, the availability of nicer working environments. So obviously, in turn, that is what is then relayed on to the employees, who are going to be able to say maybe still having a London salary, but are going to be living in Birmingham, where it is sort of a quarter of the price from say a rental perspective, or even purchasing a property. So this is where we see the growth, the opportunity. Birmingham is going to be connected to London. I'm sure many of you have heard about HS2, but it's going to be connected to London within within 42 minutes, I believe, and that is sort of improving that connectivity for the city. So again, comparing Birmingham to London, if I were to brought up an opportunity that I said was sort of a 10 to 15 minute walk from the head offices of Goldman's in London, or Barclays, or HSBC, or any of those, you would probably be looking, and this is a generalization, but you'd probably be looking for one bedrooms starting at a minimum of 800 to 900,000 pounds, and they'd be very small. You're probably on average around £1 million, whereas in Birmingham we're able to purchase properties at 200 and 220,000. When we then start looking at sort of the rent so your tenant demand and where that's going to come from, if you're able to work or live in a nice city centre location, but not surrounded by skyscrapers and tall buildings, but within a sort of Victorian nestled area of the city, and able to walk to work in 10-15 minutes, then you can see why it's so attractive. And we've had many tenants move into the first phase of the project very recently, who are working at the likes of Deloitte, KPMG, and sort of Goldman's and these other HSBC and these other firms. So it's been very popular. You can see here, so the gold star is the sort of the area of the site. This is a little bit old, this particular picture, but so this sand coloured area here is phase 2, which is completing end of this year, and where the yellow crane was phase 1, which is now all completed, tenants moving in. So as I say, you're short walking distance to all the city, where you can see the high-rise buildings and that sort of things. And then with it, you're at that end of this particular area called the Jewellery Quarter, which is all low-rise. You can't have a building over, I think it's 7 stories. A lot of them are within keeping with that Victorian workshop shop type feel that it was originally built for, which it makes it a very nice area to live. This just gives you a bit of a better idea of where it's located. So it's on the sort of the business district side of the city. Brindley Place, Centenary Square, Paradise Circus are all areas, and Colmore Business District, all very popular business areas with many of the international companies. And then you sort of walk through that area into the sort of the main CBD, the shopping area within the city, where you have the likes of the Bullring, Mailbox, Grand Central, which are all very popular shopping areas now within Birmingham itself. So a fantastic location, short walk into the city, which is just everything with this project and why it's been so popular when it's been rented out. So as I say, we have train stations from 8 minutes away to 20 or 16 minutes away, from 15-minute walk to Cornwall Business District. When we're looking at this sort of from a greater perspective, we've got London one way 45 minutes, we've got Manchester the other way in 41 minutes. So you can see why businesses have wanted to move there. They can get to other areas within the country with much more ease than let's say you've been down in London. And also, the city has an international airport, which is 25 minutes away, which all has all the major airlines now flying out of, really has turned into a hub. This is just a picture of the interiors and how they will look. Again, so an incredibly nice finish with these particular projects. We know what the finishes look like because we've already got phase 1 that's done, and we know that what the tenant demand has been like from those particular areas. So this is just another example of where we're seeing the growth. So within Birmingham itself, the statistics over the next 5 years, you're going to see 19% growth in terms of the house price, 19.8% growth in terms of house price. But actually, and you're going to see a 19.2% rise in the rates in the rental side of things as well. So it's on both elements, you're actually seeing that's not obviously happening at the same time. We're probably going to see a quieter time in terms of the house prices. They're going to sort of move around by a couple of percent for the next year or so, but rents are going up between 5 and 10% over the first couple of years, and then we're expecting house prices, once they plateau, to start shooting up again, and then rents will plateau off a bit. So you're getting a sort of a really good opportunity here, and again with this completing in Q4 2024, you're a year to 18 months, you're 18 months away from completion, which means you're able to secure a property now at today's price. We will see prices jump up a little bit over that time, but rents will go up significantly, and so you'll be able. So the yields that we're looking at now will probably be more. We're expecting rates, should I say, interest rates, to sort of tail off towards the back end of this year and get to some sort of a bit more of a normality, basically a little bit less than where we are at the moment. I don't think we'll ever go back down to the 2% or less than 3% sort of interest rates, and from a buy-to-let perspective, but certainly something more like around the sort of 4 to 5% will be quite realistic. And with rents increasing that much, and rents don't drop back down again. You don't have the volatility with rents. They go up to a certain level and then they sort of sit at that level and then maybe plateau a bit and then they go up again. But you don't see dramatic sort of sways in terms of rents in the UK when we're talking about that. So they'll get up to a certain level, they'll hold at that sort of level, and you actually manage to secure an opportunity now. Rather than when the rates start to drop, the market will become hotter, the sales market will become hotter, so more people will flood into the market, and those opportunities just may not be there because of other people coming in to buy. So I'd just like to thank you all for listening to me. I hope that covers everything, and then I just wanted to give you a quick explanation for those of you that sort of haven't dealt with the RPA group before, a quick explanation of where we are. So obviously we work with UK developers and offer their projects overseas. But it doesn't necessarily just stop there. So we're here to assist with every single part of the process. So we're here to obviously advise you on purchasing the right investment that suits your criteria. We'll also be able to help when it comes to we'll be able to help when it comes to the lending perspective, and we have partners that will be able to assist you there. We also then, once that you purchase a property and you have that side of the things sort of all set up, we have the lettings and management department in the UK who will be able to find a tenant, manage that asset for you, ensure rent's paid on time, look after the asset, ensure there's no issues. And ultimately, when you do look to exit in that 5, 10, 15-year space, we're able to help you there in the UK and looking for a new purchaser. Offices dotted for those of you that are going all around the world, in South Africa, here in the Middle East, Hong Kong, and in the UK. And I've just noticed that sort of first load of Q&As coming in. I appreciate that I'm probably going on a little bit, so let's just look through these and see which one looks good. Okay, that's fine. Okay, I think it's probably best now, rather than going on and going through all the questions. There's sort of quite a lot to answer there. So if you do have any questions, could you please drop them in an email to us? I think you should have been contacted by one of our team members, and they will be able to arrange a meeting for you to answer those questions. There are quite a lot there, and I appreciate that you've all probably been listening to me for quite a while now, waffle on, so I don't want to take too much more of your time up. So let me thank you all very much for joining me here this evening, this afternoon, or morning, wherever you are, and I look forward to speaking with you all very soon. Okay, thank you very much. Goodbye.